I haven't been in school in a very long time, but I don't know, how did the teachers do it? They raise their hand or something and see if it gets everybody's attention. I think we're way beyond that. Good morning, everybody. My name is George Kariski. I'm the chairman of the board of the Houston Mergers and Acquisitions Forum. I'd like to welcome each of you here today. It's our great pleasure to have fantastic speakers and a fantastic audience. One of the things that's key to the M&A Forum is our mission and our goals. The Mergers and Acquisitions Forum was formed almost 20 years ago by myself and a handful of other folks with a goal of focusing on servant leadership and net weaving, pay it forward networking. So those are the principles that remain the backbone of this organization, in which we like to think are differentiators. So our goal when you come here is, if you see someone you don't know, reach out. If you see someone you'd like to meet, reach out. If you see someone that needs to meet somebody else in the room, reach out. All of our board members, all of our long-term members, all of our members are committed to those core principles for M&A Forum. Make a deal with this within this room. There's lots and lots of capacity, lots and lots of skill that can be exploited in this room. Nick, thank you. Our vision is to be the most trusted M&A enterprise in the community. Again, our focus was to look at mid-size, okay, above Main Street, sometimes this little bit south of Wall Street in our transactions, but for everybody to benefit from our collective knowledge and experience. These are our leaders, our board members. If I could ask you to just stand and give a little bit of a wave so everybody knows who you are. Gretchen Lawler, Jason Lee, Austin Sedette, Alyssa Taylor, other way, Jason Jimenez, Mackenzie Child, O'Brien, Fred Ash. If you have a question about M&A Forum, reach out to one of these folks. They're here early, they'll stay late, and they would be pleased to answer any questions that you might have about M&A Forum. Thank you. We always like to thank our sponsors. You can read them yourself, but all kudos to our sponsors who help us put on our presentations. If there is not a spotlight sponsor today, I decline. We'll get to hear too much about me and my firm at some point. So thank you. Okay, no, that's great. Thank you. Membership. Jason Jimenez is membership. If you have questions about membership, reach out to Jason at any time. He has a few words to share with us. But let me ask this. How many first-timers here today? Beautiful. Fantastic. We're glad you're here. All right. Once is an anomaly, twice is a coincidence, three times is a pattern. We want to see you next month. And at that point, you need to be visiting with Jason Jimenez and talking about membership. I think we have a nice package put together that encourages membership over one-off participation. So we're going to diverge very briefly for a note from Jason Jimenez.
Good day, everybody. How are y'all? Well, so my mission here is, at the end of the day, is to make sure that everybody understands who we are, what we do, and quite frankly, why it is important to be part of this community. And so one of the things that I want to let everybody know is that we are actively looking for committee individual members that are looking to participate within the organization in certain segments of the M&A Forum. Now, why do I ask? Because we have a membership committee that is headed up that we with Ellen Williams, which, Ellen, if you wouldn't mind. So she's our membership chair. She's working on the areas and helping assist on that. She has a team of great, incredible individual members that are helping her make sure that we understand the benefits of what we do and why we do it. And also being able to understand who you're missing and who you're needing to get connected with. Because you know what you are, you know what you do, but you may not necessarily know who you need to get connected with. And our job is to make sure we connect that. In addition to that, we are actively looking for other committee chairs for other parts. Need to be expecting an email and possibly texts from me directly, just to basically engage you, talk to you, get to understand who you are, what you do, what you actually are looking for, the value that we should be bringing to you as an individual member. And then from there, ask you if you'd like to participate within the community. Get actively involved. Have another touch point with other members who are committed to this community in the realm of M&A. So I look forward to following up, but thank you all for attending today. Thank you.
Thank you. I know, just for redundancy, those of you who are first timers, again, raise your hand real quick. Members, board members, right? We're all charged with reaching out to our new members and our guests. So, new members and guests, please take advantage of this opportunity to meet some other folks established in this business community. Our upcoming events, make note, they're on the website. They're on LinkedIn. The website has been recently revamped under the sound leadership of Melissa Taylor. So sorry, I saw you. So kudos to Melissa. She's looking for feedback. I'm sure all of it's positive. So be great conversations. So.
It's not live yet. I just start.
Oh, okay. Okay. Well, I'm jumping the gun a little bit, but we're excited about the new website. Hopefully, will be too. Next, please. We're ready for speakers. I do want to give one further mention about sponsorships. Jason Lee is directly in front of me in the very back. Okay, Jason, thank you.
I'm standing up.
Okay. No boxes necessary. This is with Jason, not sponsorship. Again, our sponsors keep the M&A Forum going and relieve some of the financial burden. So we have a host of really great sponsors. But if you get a call from Jason, take his call, okay? Not just because he's asking you for money, but because he can provide you with an opportunity, okay? And Jason's a good person to meet in any event. So it is my profound pleasure. I just met our speakers this morning, so I'm looking forward to your presentation. Y'all are mic'd and ready to go. So the founder's journey, private equity, and employee ownership. Kirsten and Victoria, welcome to the M&A Forum. Look forward to your presentation.
Is mine on? There you go. Oh. Awesome. Well, it's great to meet a lot of you in person. And for those of you we haven't gotten a chance to meet yet, welcome the opportunity to speak before, during, or after. Our goal is to spend some time doing a presentation in and around how we as SkyKnight have thought about investing in the private equity space with a specific emphasis on employee ownership and the role that can play with private equity. We'll start by giving a quick overview of ourselves and the firm, and then kind of dive into some examples of portfolio companies that we've worked with. Maybe to start, I grew up in Kentucky, so I'm not great at directions. So I'm Victoria Potter. I'm a managing director. I'm in our New York office, and I lead our efforts across industrials and infrastructure services. So I joke that I get to spend time in the sexiest part of the economy. If it involves a utility, transportation, oil and gas, or trash, it's normally something I'm excited about. I studied chemical engineering in school, and so my dad jokes I've taken the most circuitous route possible to spend time with engineers. Spent early part of my career at McKinsey & Company, actually here in 609 Main Street. So that was the first office I ever worked out of, was here in Houston. Lived in Upper Kirby at the time, and still enjoy getting back to Uchi and El Tiempo when I get a chance to. So thanks for having me, so I can try one of those out tonight again. Spent the early part of my investing career at Blackstone, worked on a number of different transactions across the broader industrial space, ranging from Geosyntec Consultants, which was a geotechnical environmental engineering firm, kind of one of the pioneer transactions in employee ownership alongside private equity, to Copeland, which was the carve out of Emerson's residential HVAC business into a standalone entity. And then joined SkyKnight in late 23 to build out our infrastructure services practice as a firm. Since joining, I've led 4 of our platform investments. First is a business called Empirical, which is a power engineering firm. Second's a business called Force Electrical, which is a utility field services business. For anyone who was without power this weekend, they serve the Houston region, so they were a part of repairing that. McKay, which is a water and transportation engineering firm. And then most recently, a business called Wasteology, which is a managed waste services business.
Awesome. You guys hear me?
Are you on? And do you want to?
Yeah, I'll take it. Awesome. All right. I'm Pierce Katisha. Joined SkyKnight a couple years ago. Grew up in Cleveland, Ohio. So a big you're welcome for the Deshaun Watson trade. We're Browns are still reeling from that one. So prior to SkyKnight, I was with a firm, Altamont Capital, for about 5 years, and actually opened an office in Austin, Texas, where I lived for a couple years. So I joke that I think my family is the only family to move from Texas back to the Bay Area. My wife is from there, though, so that's my excuse. But I lead our business development and capital markets team, so work with Victoria on the infrastructure services vertical, oversee our other verticals as well. And as Victoria said, we're going to talk you through quick overview on SkyKnight, maybe what differentiates us, and then we'll dive into a few case studies and really focus on the employee ownership aspects. So SkyKnight was founded in 2015. We joke at the time, the last thing the world needed is another private equity firm. And so really set out to differentiate ourselves and take a unique approach. And there's a few ways that we've done that. One, we took a very focused approach to building out our investor base. So it's a lot of U.S. endowments, pension funds, family offices. And in doing that, they've given us a flexible mandate to invest our fund. So our current fund is a little over $1 billion. We have north of $4 billion in assets under management. And the way we differentiate, first is our hold periods. So we can hold our investments for 10 years or longer versus the traditional private equity firm, usually turning around investments in 3 to 5 years. And then we can invest up and down the capital stack. So we can take minority positions in companies, which we've done. We can take majority positions as well. And kind of everything in between. So we've had situations where founders think they want to sell a majority. We'll work through the process with them. And towards the end, we'll say, you know what, I only want to sell a minority. We're able to pivot. And really the goal is finding companies and teams that we want to work with. And if that's in a minority position, great. If it's majority, that's great as well. In terms of where we focus, we have 3 main verticals, but across those 3, the recurring theme is almost entirely services, human capital type businesses, where, again, we think the employee ownership is especially important with those business models. But the 3 verticals we split it into is financial services. So within there, we've done a lot in the insurance industry, healthcare, and then the last one, which is somewhat of a catch-all, is tech-enabled services. Within there, we own a car wash platform based here in Houston called Whitewater. We own a couple HVAC investments, so a commercial HVAC business, First Call out of Austin. And then as Victoria mentioned, we are actually debating spinning out a 4th vertical, given our traction in infrastructure services. So we have done a lot in, call it engineering, and now environmental services as well. So this is a quick snapshot. Some of this we hit on, but going back to our founding in 2015, we've invested in 22 platforms. Of those, 19 have been founder-led businesses where we are the first institutional capital coming into those companies. 85% of the businesses we've invested in have had at least 25% employee ownership. And then the average across those is 45%. I hit on our hold size. So typically, we're holding our investments for 6 to 10 years or longer. So we're still in the first deal. We invested in a company called Amwins. We've invested into that business out of each of our funds, and we're on year 10 of our position there. And then lastly, additional capital. So we are much more likely to put additional equity into our investments, whether it be to fund M&A, to pursue strategic growth avenues. So of our 22 platforms, 9 of them, we have put additional equity into the company beyond the initial investment date. And then here's 3 high-level snapshots of investments we've made. So Empirical, I won't steal Victoria's thunder, but we did that one summer of 24, started very small. That was 11 of EBITDA. We partnered with founders there who owned a majority, wanted to keep a meaningful portion, but looking for a partner to help grow that business. That's 40 million of EBITDA today. Whitewater, we invested with the founders very early on, and then helped them attack a de novo strategy and also do M&A as well there. And that business is 60 plus of EBITDA today. And then the last one, Amwins, is a large insurance distribution platform. This is an example of us being able to participate in a minority structure. So we've been a minority investor there from when it was 200 of EBITDA, north of $1 billion today. And then these blue boxes here, so this is our entire portfolio. These blue boxes highlight the companies that had 25% or more employee ownership at the time of our investment. And then we had put this slide together. It's probably tough to read, but this is our entire portfolio. We like to show this as we're not hiding anything. So this is every investment we have currently. The one takeaway we're proud of for the most part, if you look at our investments, if we've been invested for 3 or more years, the company has been able to at least triple in size, and in some cases significantly outgrow that. And then we will pivot to Victoria's section. Fun fact about our firm, Texas is our #1 state in terms of platform investments. So I hit on Whitewater, based here in Houston. We have a dental business, Pearl Street in Dallas. And then we have a company, First Call, out of Austin. First Call is one where, going back to our flexibility, we had an executive who had a thesis in the space, literally just a PowerPoint at the time. We did our homework on commercial HVAC, decided it was a sector we were excited about. So we backed this founder with 100 million of equity to kind of build the business from the ground up. He's done a great job scaling it. We've brought in partners since then, and the company is north of 300 million of revenue today. So I'll kick it over to you.
Awesome. Thanks, Pierce. So as Pierce alluded to, more of our portfolio companies are headquartered out of Texas than any other state. As a fun fact about me, our firm retreat, the activity we did was archery. And everyone can guess based on the end of this what place I came in the archery competition. Because everyone liked investing in Texas. And so I started and I said, great, I'm doing industrials and infrastructure services. There should be a lot of investments to be made in Texas. So I started on the journey. Where was the first one? Oh, wrong one. Almost Texas, Louisiana. So Empirical, which we'll hit on, power engineering firm, headquartered in Covington, Louisiana, which is a suburb of the New Orleans area. You get to take the longest bridge in the country to get there. For anyone who hasn't done that before, first time you get on it, a little confusing. So then I kept going. I said, let's see if we can find another investment in Texas. Ended up in Oklahoma City, 3 hours from Dallas. So made it pretty close, but not quite there. So then I said, okay, continuing the investment. Where will we land? I ended up back in my home state of Kentucky. So needless to say, I did not win the archery competition. I came in completely last. And my aim with finding companies in Texas is about equally as strong. But we'll keep going, and maybe from the conversations today, find a great opportunity to invest in a business in Texas. Each of these three we'll hit on over the course of this presentation, starting with Empirical, which we've been fortunate to partner with for almost 2 years now. For that one, we'll do a bit of a deep dive and just talk through how do we think about investment framework, what are the core tenets we look for in thinking about a company to partner with. We use a framework called SCORE, sector, company, ownership, returns, and edge. So we'll walk through that for Empirical. And then today we wanted to specifically spend time on ownership, because as we think about the 5 different tenets of the SCORE framework, we found that the one that distinguishes investments the most, both across our portfolio as well as the portfolio of other private equity firms, is ownership. At the end of the day, growing and scaling businesses is only possible when you see equity across the employee base and the excitement to see the continued growth. And so while there's a number of accounting and legal logistics to jump through to enable that, we've as a firm spent a lot of time crafting a playbook to enable each of our investments to put equity in the hands of as many employees as possible. So we'll start with how we think about investing, and then, like I said, we'll deep dive into the ownership piece for both Force and Wasteology as well. So Empirical's a power engineering business headquartered in Covington, Louisiana. Real picture, not AI generated. even though I get asked that regularly. Their business was started in 2008, just after the Great Recession. The group spun out of Entergy, the utility in town. That was the time of a lot of the utilities starting to take their deregulated businesses, or the portions that are not part of the rate base, move them into separate entities. Given the challenge of being in that group in 2008, they said, I think this will be easier if we try to go do it on our own. If not, we have nothing to lose. And that was hence the founding of Empirical. As you can see, the business has seen significant growth since then. And for us as SkyKnight, as we thought about investing and partnering with the business, I'll just kind of walk through a set of slides to talk about the framework, starting with sector and going down to edge. So from a sector standpoint, this was 2 years ago. So I will say it wasn't every other headline that, oh my goodness, data centers need a lot more power, but it was maybe, every 100th headline at the time. But we started to study the power space as it relates to the amount of growth that's needed. And while the AI piece, which is in the bottom right-hand side of the page, is an important tailwind against this, what we found as we studied the utility space is that there are actually a number of tenets that made it an interesting sector for growth, which is typically our focus when thinking about spaces. You don't want to rely on a single tailwind to drive you home, because politics can change, the world can change. You kind of never know what will be thrown at you. But if you have 3 to 4 different tailwinds that are enabling the growth of a business, you can continue to sustain, through a number of different economy situations. And so at the top left-hand side here, you can see relative to the useful age, our transmission and distribution infrastructure is significantly past the end of its useful life. This is why when ice comes to Texas, people's power goes out, very simply put. The utilities are continuing to see the retirement of both engineers and linemen within the business, which is leading to incremental outsourcing because it's challenging to hire those individuals into a utility. You can see that from a CapEx standpoint, or the sources of funding, you've not seen any significant change during recessionary periods. This kind of goes back to the dot-com bubble in the first one. Then you see the great financial crisis, and then most recently COVID, which actually saw a pretty significant uptick in utility spending. And then finally, you kind of take these 3 different component pieces and you throw on top of this the data center wave, which is leading to an interaction of technology behemoths and utility companies, which, if anyone spent time with both, are probably the 2 most unlikely groups to work together within the economy. And so then we get to Empirical. And, as we think about looking at the company itself, we want to see a track record of continuous growth. That's what you see on the left-hand side here. From a service mix standpoint, don't want to see a business that's completely focused on one singular activity, to where if the utility decides to insource that, you've now taken away the entire business model. So diversified service mix compounded with the diversified customer mix. You can see a number of different utility logos there. And then finally, a track record of being able to do work that was front of mind to utilities. So this may have hit some folks' headlines, but Meta is building out their largest data center complex in northern Louisiana, Richland Parish. Empirical is a part of designing all the substations and doing the construction management for that work. Ownership. So this is the most important one, and this is the one we'll hit on for the other companies as well. As we've studied both our portfolio and other portfolios, when you look, across an aggregate of a lot of different funds doing a lot of different things, we found that companies that have 30% or greater employee ownership, meaning 30% of the people, not necessarily the capital stack, but the people, are invested in the business alongside you, have a 60% greater likelihood of achieving a 2 to 3x return. Very simple stat, very simple concept, but turns out if people feel like they have a stake in the game, it's a very different outcome that gets achieved. And I think this takes place across a number of different component factors. One is the desire to stay with the business, attracting and retaining people. See a lot of head nods. One of the most challenging things to do in a day-to-day basis. 2, it leads to folks thinking about it like their own business. We don't monitor expenses in any way, but I've had CEOs say, it's amazing, like what bottles of wine people don't order anymore once they have equity in the business. And then I think, most pertinently, it leads to a degree of employee satisfaction, which you can't quantify from expenses or from retention, but more so from generally feeling like they're a part of the mission and a part of the journey. So as we thought about Empirical, when we first met the company, the business was owned 100% by these 4 gentlemen you see in the top left-hand side. As a part of our transaction, we essentially retained or acquired 60% of the business. They retained 40% of the business. To hit on Pierce's initial point, we oftentimes approach companies and we say, tell us what's interesting to you from an ownership structure. So this conversation started with us acquiring 40%, them retaining 60%. Then as the conversation continued, they decided, kids are going to college, maybe we do want to take a few more chips off the table than initially thought. And we landed on this structure. And I think this would have been a pretty good outcome if you look at private equity ownership across portfolios, but it doesn't achieve that stat that we talked about previously of seeing 30% of the employee base, not the capital stack, which I think is the important distinction. And so we introduced an employee ownership program at Empirical that allowed any employee to buy shares in the business at the same price point that we invested in the business at. It was essentially diluting us, putting cash on the balance sheet. So the business had incremental cash to do M&A, build a new office. There are a number of different reasons. But the purpose of doing that was not because the company needed cash. We had just made a large equity injection. There were plenty of cash on the balance sheet for the business to continue to scale. It was because getting to 30% of individuals that have ownership in the business alongside us was what was going to lead to the return outcome that we were focused on. And so you can see here that it's part of that first offering. We went from 4 people being employee shareholders, like I said, these 4 gentlemen here, to over 100 people being employee shareholders, 1% to about 25%. And through this first offering, 2/3 of the shareholders that participated purchased more than the minimum buy-in amount. So we set a minimum that was attainable for everyone, kind of around income, and 2/3 exceeded that. So this was year 1. We've just recently had the first anniversary, if you will, of the employee ownership program. And the way it's structured is each year we have an outside valuation firm or outside firm do a valuation of the business and agree upon the share price based on the growth that it's achieved. We then have what's the equivalent of like a benefits open enrollment period where we have an employee shareholder event. It's the most fun presentation I give all year because everyone's sitting there with their calculator out with the number of shares they have times whatever price I'm going to say. But we have an employee shareholder event where we released the new share price. This past year, or this first year of partnership, the share price went from $100 a share to $250 a share. So pretty great outcome for all the employees that invested alongside us. And that opens an open period where employees who are interested in achieving liquidity can sell up to 25% of what they own. So you have kind of a 4-year sell down, prevents it's a wonderful life run on the bank scenario, but allows people to have liquidity over time. And then on the flip side, employees who want to buy more have the option to buy more. So I'm excited to share that we've now achieved the goal. We have about 37% of the employee base invested from a headcount standpoint. So this slide is now officially stale as of yesterday. And it's, sure, yeah.
Is this a model that you use with other investments to get buy-up the employees?
Yes. I have 2 more case studies.
Well, we're asking questions. Why didn't you consider an ESOP instead of this format? And I'm asking that as a former CFO of an ESOP, and I hated an ESOP. But I wonder why you didn't do an ESOP.
Yeah, it's a good question. So a couple things. My understanding, and I'm going to start this by saying, I am never the smartest person at taxes in any room, and I'm certainly sure I'm not in this room based on some folks I met beforehand. My understanding is being a private equity firm with majority ownership, like the U.S. government would not allow us to be an ESOP from a tax standpoint. So I don't think we were allowed to have that option. But the other piece of it is, I think part of the reason for setting up an ESOP, once again, not the smartest tax person, is because of the tax advantages that you receive. And it doesn't allow you to have this 25% annual liquidity. And that's been one of our unlocks as a firm on how do you actually achieve this, is to have the ability for folks to get 25% liquidity a year. What you see in a business like Empirical is, it's to a degree a bit of a pyramid, right? Not dissimilar from law firm or, other professional services firm. You have a ton of young engineers at the bottom, and then, it kind of works its way up. So you want to set it up to where those, 25, 26, 27-year-olds are excited to invest, a portion into the business. But if you tell them they can't see it for an unknown amount of time, they're not going to do it, right? Like buy the first house, have the first kid, whatever life event may prevent itself. If they know that there's the opportunity for 25% liquidity annually, you see a different behavioral pattern. Yeah. Okay. So now we've talked about ownership. Going through returns and edge is not that exciting, but we'll hit on this quickly and then we'll go back to more ownership examples. So from a return standpoint, we always get the question of like, there's this mysterious investment committee that happens, and if you've spent time on the other side or on either side of a private equity transaction before, there's copious amounts of data that are asked for. And it's like, why does anyone need all of this? I think at the end of the day, it's, fundamentally understanding what are we stepping into and what's the likelihood for growth of what we're stepping into. And so for Empirical, we spent time around the backlog and the pipeline. We essentially had 4 years worth of coverage. So that kind of gave us comfort with the projections to follow. And you could see that there was significant backlog and pipeline that was won over time, driven by the data center build out. So once again, we like this because 4 different growth drivers, not just one, but I think from an underwriting standpoint, we could see what was coming through from a data center standpoint. And then finally, edge. All the things we've just talked about are great. But at the end of the day, if a company doesn't choose to partner with you in the build up to this, none of that matters. Yeah, it's the end of the day. And so we spend a lot of time generating an edge by working with the CEOs that we're stepping into this partnership with on what does the roadmap look like for the next 5 years together. And this is a very simplified version of a deck that, as you can probably imagine, had a backup to the backup to the backup page behind it, but outlining what the partnership together would look like. And as you can see, components of what are written here are the employee ownership program that now has come to life. So this is the story of Empirical, kind of walking through the 5 different components of the SCORE framework. As shown likely by the questions, also my own excitement, O is our favorite. And so instead of having everyone drown through the 5 different steps of every deal I've worked on, I just saved the O for the others because I thought that would be of the most interest. So Forest was the business that I alluded to, that if your power went out this weekend, they were most likely working on your utility line. So it's a utility field services business doing transmission and distribution services for utilities. They're based in Oklahoma City. Once again, not quite Texas, but I got pretty close. And they serve Oncor, Centerpoint, OG&E, AEP, kind of number of utilities in and around the space. This one was an interesting, rollout for us because you're working with a group of individuals that are linemen, and that industry is typically structured where there's a lot of transition between companies. Folks will have work that moves from kind of one area to another, and they'll say, I don't want to stay at this company anymore. I want to be, within 20 miles of my home. So it's a much more, I'd say, fickle workforce from a retention standpoint. So as we were talking to the CEO, we're like, let's see what happens. If we roll it out and no one decides to participate, no harm, no foul. What's been interesting to see is particularly after the open program for year 1 is happening right now for this business. So we're live in the makings of it. But as you can see on the left-hand side here, management team all rolled over 50% of their proceeds from the transaction. There's kind of a silent third-party investor behind this business. So we cashed them out. Management team saw significant rollover. And as you can see, we kind of started as 73% ownership of the business. We now have the employee ownership program out and running, and we've already achieved about 25% of employees who have chosen to invest in the business alongside us. I think it's an interesting statement on kind of regardless of the workforce, white collar, blue collar, something in between. The opportunity to invest still did seem to really attract folks, and by choosing to invest, they're committing to being a part of the Force team for at least a 2-year time period with how the documents are written, which is interesting for a workforce that historically saw 40% turnover year over year. And then the last one is Wasteology. This is the managed waste services business in my home state of Kentucky. Similar story to Force, where there was a silent family office group. Fun fact, it's Rick Pitino's family office. So for anyone who's a basketball fan, Kentucky really does run deep in basketball heroes. We were able to cash that group out. Predominantly, they rolled a small amount alongside, as you can see, the 5% there. Stacy, the CEO, retained significant ownership, and then Alex, the CFO, was able to gain ownership as part of the transaction, which led us with around 65%, and the employees and Salad family office with around 35%. And then once again, similar to the other programs we've hit on, we then rolled out the employee equity program for there. We've just closed this one. So I think these numbers are fresh, but we had 33% participation there. And so kind of achieved the goal of staying over 30% of the workforce invested. So not to put in a plug to get an incremental invitation, but I would say what's interesting about this is we're in the, juxtaposition of now seeing if what we've seen statistically across portfolios is true in businesses. And I think for Empirical, we've had 2 years worth of time to see that having 30% invested has led to the business more than doubling within that time period. For Force and Wasteology, we can come back in a year, give everyone an update on what's happened. But that's been one of the joys of working through these employee ownership programs with the CEOs we've partnered with, is it's a theory around it's very simple and makes sense when you think about it, that if people have equity in something, they're more incentivized. But I'd say we're still proving it out day by day with the companies that we work with. So with that, unless anyone wants me to read this to them out loud, I think we'll turn it over to questions. Sure. Oh, sorry.
When an employee leaves, do they have to sell?
They do. They get bought out at the last share price that was externally calculated. So to stay in the good graces of the SEC, we do not do any share price calculation ourselves. It's all done by a third party group. So if the third party valuation is done in June, decide to depart in August, you look back to that June valuation, and that's what valuations utilized. I'm going to start this way and go over. Oh, okay, never mind. You're going to go first.
When you go through that sale process where employees can sell their stock, can other employees cross purchase when they say, someone wants to sell, another employee say, oh, I'm going to buy more in it.
So that's exactly right. It's a buy and sell program. Think of it as like an open enrollment. It's at the board's discretion, and the board has to formally approve what employees come back with from a survey standpoint of requesting. But the hard guardrails are you can't sell more than 25% in a given year. So it's kind of a 4-year sell down, and that we do give the opportunity to buy every year. So there's always the opportunity to buy more. Further dilutes us, puts cash on the balance sheet. Most of these have been acquisitive from an M&A standpoint, so that cash then just goes to the use of M&A. But how much we allow employees to sell in a given year is up to the discretion of the board. If we had a kind of significant amount to where it was going to shift the cap table in a way that led to a difference in voting rights or something, we would have the discretion to pare that back.
And the other question is, so you have this one employee selling and another Wi-Fi gets pretty cross-fine, so you don't get diluted. So there's no cap at you.
So it all works through the business, but if it was to work out to perfect math, to where like the portion that wanted to sell was the exact same as the portion that wanted to buy, you're correct. We would not have any dilution. Reality is it doesn't typically work out that way. What typically happens is we do get diluted further, which we willingly accept because we think that the benefit of employees being bought in is worth the dilution. But there are some times where there's a little bit more of a desire to sell than to buy. And so we actually then increase our ownership.
And just to point out, this element, from what we've heard, is very unique, having that sort of open market annually. And the whole program, candidly, we've purposely tried to build it as straightforward as we can for the employees, where it's obviously not trading like a public stock, but it's a very straightforward, hey, here's the share price. You guys are invested at the same exact level as us. There's no preference. In a year after that, there'll be valuations. You'll have an opportunity to sell or buy more, which we've kind of tweaked throughout the years.
Yeah, thank you. Thank you so much for your time. And my question is, so do you have a particular size of business where you feel like this model works well, or is there like a size that's maybe too small, or is that something that we'll consider as well?
It's a good question. I would say we typically invest in businesses that are somewhere between 10 and 30 million of EBITDA. It can look and feel like that. Those aren't like hard guardrails, but I would say that's typically been our investment size. And I think we find that it works well within that. Geosyntec, kind of going back to my Blackstone days, was a business that was like 70 million of EBITDA. The program felt a little different than this. I would say, to Pierce's point, it was not as straightforward because there were so many more people involved that you had to put more guardrails around it. So I would say the way that we've structured this works well within that size. And I think the questions asked, it has very limited guardrails of like, can't do this, can't do that, which I think makes people more willing to do it because it doesn't seem like there's a lot of legally, there's a lot behind it. But I think you could make it work, and I have seen it work in a larger business, certainly. It's just a little bit more complex to administer and facilitate. I think if you get much smaller than 10 million of EBITDA, the buying and selling market, you just have to be prepared that it's probably going to be very lopsided one way or the other. And so you're either going to have to be prepared to dilute quite a bit or buy quite a bit each given year. So if you have the cash reserves or equity reserves to do that, I think it could certainly still work. But I think the math gets a little harder to administer within a company setting.
Thank you.
Some question I have, two more questions. What would you say the percentage of entities are that you're going after versus people coming to you? That's the first question. And the second question is, if you were to put the criteria's high-level bullet points of what you want to be checked off in order for you to say, yes, I'm willing to engage, you're willing to get to the finish line, what would those be?
Good question. So it's an interesting, the first one's like an interesting one to answer, because what I would say is there's an element of coming to, have presentations like this, going to conferences that, we're doing because we are looking, at the end of the day, my job's to find incremental businesses to invest in and to be their partner for growth. That's like what I wake up and think about every day. So some of it is, you go to a conference and then you meet someone who's also looking for someone in the matchmaking career. So you come to a setting like this and you get connected to someone. So, I think if I look at the transactions, it's probably about 50-50 of like, they made the first move, we made the first move, to go back to the dating setting. But I think, typically both parties are actively looking. I would say that I don't view this, I joke, I'm like, this is not like, selling Girl Scout cookies, which I enjoyed doing at one point in my life. Like you don't find like willing participants on the street. Like if someone's going to like sell their business, they've kind of made the decision, and maybe you help speed it up 6 months or something, because they've come in contact with you like, this is specifically unique. But it's not like Thin Mints. It doesn't fly off the shelf. And then on your second question, think about criteria. I think I'd go back to the SCORE framework, as a kind of premise to hit on. So I think from a sector standpoint, something that has multiple tailwinds around it that enable it to be a space that's growing multiples of GDP. That can mean a lot of different areas of the economy, but kind of having multiple ways, as we kind of think about this slide, to get comfortable with the market growing at least a multiple of GDP. I think from a company standpoint, consistent growth track record. We often say like we are growth investors and partners to founders. We've never done a turnaround. I have no idea how to cut costs. You can ask my fiance, very bad at it in a lot of aspects of life. We want to be someone's growth partner and focus on helping them grow and scale. And so I think that's, as you think about the company itself, if someone needs a turnaround, like there are groups that do that. We're not that. If someone needs a growth partner, we are that. Ownership, we do predominantly founder-based businesses or businesses that have been passed down through employee groups. So I've done ESOPs before, but typically we don't work with businesses that have already had some form of private equity before. That being said, there are situations where someone's had that, the employees want significant ownership, and it does make sense. But I'd say on average, something that's mostly employee owned at the time, as you can see from the kind of last two examples I went through, there's a number of them that are still predominantly founder employee owned, but they've taken some type of silent, and they kind of want to clean that up, sell more themselves, and we're the right group to do that with. Returns, just ability to see the forward growth of the business. For software businesses, like you don't even need a page like this. It just, you can see it from the recurrence of the revenue. For most of what I do, it's typically backlog pipeline, what are like coverage ratios that allow you to have comfort with the price that you're paying. And then, we say edge, but it's honestly like alignment of what we're going to do. It's a process to get through a transaction, but it's a journey to go through partnering with someone for 5, 7, 10 plus years to grow and scale their business. And so, not having kind of this level of alignment up front typically leads to someone being frustrated on the other side. Yeah, of course.
Yeah, I have a question about Pearl Street. Are you targeting individual dental practices or platforms or other DSOs up to recommendation?
Yeah, I'd say all of the above. It's about 50 locations today, almost entirely Dallas area. I think we have 4 or 5 in Oklahoma as well. We've been acquisitive there though, so I'd say most of our acquisitions have been in the 1 to 3 or 4 clinic range, but we have looked at some more transformative ones as well.
Are you doing joint venture or are you doing 100% ownership?
We're doing mostly JV at the clinic level, yeah. So that's one where different flavor of it, but same thing in terms of the ownership alignment concept and making sure that the dentists there have the alignment we'd want with other employees.
Real quick, how does the employee engagement in ownership change the dynamic in the C-suite decision-making room, the boardroom, in your experience? I'm just curious because it seems like you have some pretty significant cultural dynamic shifts there. So I'm curious, can you speak to that?
You know, it's interesting because I've had like CEOs when thinking through all this ask me that exact question. And a lot of them are founder-backed businesses to where there wasn't really a boardroom discussion before. It was like, you know, them with their partner at home saying like, you think we should invest in this or should, you know, like doing napkin math, as some of them joke to me. So I think that it's an overall transition the business goes through, right? Where every decision feels like that individual's checkbook. And this is them kind of saying those exact words to me versus me saying that, versus it being in a partnership with someone. And one of our CEOs, I've heard him talk about, you know, starting this like partnership with SkyKnight as being like getting a personal trainer for business. Yeah, it's like he goes to the gym every day. He's got like the trainer he uses. It's like, you know, that person is who inspires him to go from, I don't lift weights, as you can probably tell, but yeah, 350 to 370, or like whatever it is. Like that's, you know, the person has the accountability. He's like, you're the equivalent of that for business. Like, you know, when I show up to meet with you, it's like there's an accountability of like, you know, how are we growing and scaling the business and thinking about the future together. And so all that to say, I think the employee piece is embedded in that. It's like a wrapper of that versus that piece specifically changes things. But I do think a lot of the businesses see a shift from, you know, individual person, like I said, at their kitchen table with their, you know, partner or their CPA, personal CPA, or not saying like, oh, should we open this headquarters, not, you know, open new headquarters or not? Should I, you know, invest in starting an office in this city that I don't have yet or not, to doing it, you know, in partnership with someone and kind of with this backdrop of, you know, all of your employees are invested in the growth and success of this as well. So when you do make that decision, it doesn't go from, you know, I'm asking you to do this favor because I own 100% of the business and this is going to help me grow it. It's, you know, you have equity in this business alongside me. We're all growing it. You know, I need you to go start the Lubbock office or, you know, to take a Texas example. Does that help? Yeah.
I just want to ask about like the competition of private equity firms at like the EBITDA 10 to 20 billion level. Like how many firms are kind of like focused in this little area?
I don't have an exact number, but quite a few. I can tell you that. I think that
Or then there's as many PE firms as are McDonald's locations.
yes, exactly. I was going to say, yeah, there's a famous, or now becoming famous, I guess, quote that I think it was the CEO of KKR or someone who senior in their private equity business, said at a like CNBC interview of there's as many private equity firms as there are McDonald's in the country. I'm not entirely sure that's true, to be honest. Like the competition doesn't feel that stiff, but there are a lot, all that to say. And I think I think that's what leads to the need to be, you know, specified in what you're doing and to have a, you know, a value proposition that's unique from others. Because if you just show up and say, hi, my name is Victoria, I have capital, people are going to say, okay, so does like Tim, Robbie, and John, you know, who have been in my office over the last week. And I think that, you know, we've as a firm been focused on what do we think drives returns, but also makes us a unique value proposition to a company that we meet with. And that's essentially what we've hit on today.
I think about the earlier question too. of like who comes to us versus us going to them. It's so competitive that even if it's sort of the perfect match, you have to do everything you can to win it. So to Victoria's point, we try to differentiate where we can. Empirical was one where we knew we were competing against strategic, so we actually told the founders we'll use 0 debt day one, which is very rare. But hey, let's grow this together. You won't have to worry about covenants or anything like that. And then once we scale it, we can think about it. So
It's just one quick so in the like 10-20 million bracket, like where do businesses sort of located mainly in south, in the west, north?
I would say like across the economy, all over. I do find that I think partially driven with how economies have evolved in the country. Within the spaces I spend time in, industrials and infrastructure services, the Southeast is much more prominent for businesses of that nature. But I think if you were to ask, my colleagues in financial services, they would say Northeast and West Coast. So I think in general, depending on what pocket of the economy you're focused on, you could find them all over. There's probably an industry specialization more than anything. Yeah, of course.
When your platforms make acquisitions, how do you handle the ownership plan? That's
Good question. So if it's a small acquisition on a relative size, we will wait until the next EOP offering that's already in place. If it is a larger one, we will open it as part of the closing of the transaction. So we'll have like a special offering for those individuals. Sometimes it's something that's like negotiated as part of the deal, because sometimes the group that's joining feels really strongly on their team being able to have that. And I will say I've now 6 or 7 times sat in the room, presented, or just been there when, we've done the rollout of the partnership to the employee base. So it's like, founder owned business. And it's like, we got some new friends, like here they are. And I think that the conversation is very different when you can end on the note of not only, is this exciting for us for the growth of our business, but also you get to participate in that alongside us. And so that's why, especially for larger acquisitions, we're very focused on being flexible to open it at that time. And it creates, the reason we don't do it for every single acquisition is it does create a degree of legal and also valuation work, because once again, we don't determine the price ourselves and feel very strongly about that not being something that's determined by us. And so we can't do it every single time, or we would just constantly be doing evaluation, which, becomes challenging to keep up with. But for a business called McKay, water and transportation engineering firm, we did a transaction June of last year that was effectively the same size as the base. It was in some ways a merger of equals. The group called Engineering Analytics, their founders were retiring. They kind of had this next generation, didn't have the economics to buy out the founders. Joined us. They cared a lot about rolling. They cared about the people who were kind of the next generation folks having the ability to have equity in it. So it's all a long way of saying that group, super important that we opened up the employee ownership program. And so the day that we announced the transaction, we had the valuation work already done to where we could open it up that day. And those folks could have a month to kind of have the open enrollment period.
Hi, how are you? This is my first step.
Yo.
You're loud enough.
All right, I can. So, I'm Miguel Sanchez. I represent a group of companies that I don't know what actually private equity means, because you guys are kind of institutional, and we're a group of companies with a bunch of friends, and we bought Granger National Bank, it's a little 160-year-old bank. We bought it, and we opened our second branch right here down the street. We also opened Bari restaurants. We own that as well. We have a publicly traded company in the penny stocks. We're experimenting with that. So I'm finding out a few details from my partners to see what our EBITDA is nowadays, to see if we can qualify. But it's definitely very interesting. I have a ton of questions in regards to the different entities that we have here. But then we also participated in the financing of the building right across the street, which is the Astoria. We brought in $20 million, around or $23 million in equity, and we also brokered the construction financing for that, and a few other buildings around here. We have a few of the real estate projects that have some pretty good IRR returns. And I don't know if you invest on something like that transactional. So I have a bunch of different questions. I'm going to be with you guys afterwards.
We've
But-
got cards up here.
Sorry?
We've got cards up here in general.
Yeah, so I don't know if it's gonna be the right fit or not, but we have a bunch of monies and a bunch of different businesses, and we'd love to consult with you to see how can we in the future or something. So, but what is your target IRR initially? I know that looks like what you guys is go long term on these deals, and do you also invest in large real estate projects as well? That's my two questions: IRR, and then if you invest in real estate projects.
Yeah, so we don't do real estate yet. Maybe over time, but not at this time. From an IRR standpoint, we actually typically think of the world as MOIC, multiple on invested capital, versus IRR, because we try to avoid the time component of IRR, being longer term investors and partners to businesses. But 3 to 5x multiple on invested capital is how we think about it, and then from anywhere from a 5 to a 10-year period. So kind of back into what IRR range that would imply, but that's like the framework, I would say, when we're having our investment committee discussions, versus like, have you hit a 20% IRR or not?
Thank you so much.
Yeah, thank you.
I got one.
Okay.
So whenever you talk about partnering with these businesses, helping them grow and scale, I've been able to piece together, obviously you're getting them access to equity, to capital, and then you got your EOP. I saw something, I think, on a slide around helping with strategy. Can you elaborate a little bit more beyond those things? What else are you doing to help them grow and scale?
Great question. So I would say for each business, it looks and feels different. But I think this is maybe like a concrete one to walk through with empirical. And then this always happens where people ask good questions, and then you're like, I have this other slide that if only I had included it. So I have another slide we'll talk about later with that. But we typically work with companies up front to align on a 5 to 10 year strategic vision. And this is before any dollars exchange in any direction. For most businesses, it's organic growth. So how are we going to grow, without doing M&A? For empirical, I appreciate this is small, so I'll just kind of hit on the points here. But first was adding additional investor-owned utilities that were outside of their current geographic footprint and adding the sales force to be able to do that. Second was capitalizing on key relationships like data centers to deliver more of the services that they were looking for. We saw that there was an expansion of desired service offerings. So that was, making the decision to hire people who were essentially going to be a net loss at the beginning. They weren't going to be profitable, but over time, would be able to build out practices to where they were. And then the third piece is, and this is what we've hit on so much, but becoming employer of choice through a culture of training and development. This also hits on the EOP side, but there wasn't a institutional training program that existed. I would say the HR department it existed from a functionality, like corporate compliance standpoint, but there wasn't the, here's how to become from an engineer to a project manager, what are the skills you need to learn? Like, what are the training? And so those were the three things on the organic growth side that we made a commitment to each other. If we're going to put the dollars in to invest to see these play out. And then M&A, I won't hit on each of this. It's more, commonplace, but doing transactions to grow the business in different regions. And then the last piece, the business had a history of internal technology development, but I would say it was always in some ways contained by capital. There just wasn't the outside developers they could bring in, or whatever it may be. And so we've spent time with the team, both from a strategy standpoint as well as finding the right partners to do the outside development on doing some of the kind of drafter designer work, which is the more basic engineering work, through automation tools. So if you've ever designed.
So there's a decent amount of cross-pollination of knowledge and lessons learned across the portfolio that you bring to the table with any new.
That's right. And we have a portfolio operations team that are what we call topic specialists. So someone on our portfolio operations team that spends all of his time with talent. So that's, as you're thinking about doing these like extended hiring programs, if you never had a general counsel before, you need a general counsel, whatever it may be, that's where he spends time with our teams and provides support in that way. We have someone on our team that spends all this time on technology. So this last pillar here, was his pillar. And same is true for other businesses. He formerly was at McKinsey & Company, working with Fortune 500 companies on their technology and AI strategy. Now spends time with our portfolio companies on that directly. And then there's someone on the finance side. Say Pierce spends time with companies on capital structure, so debt facilities that make sense for the growth that's occurring. There's also someone that's in the portfolio operations team that spends time on the financial planning and analysis side to bring all this to life with numbers.
Thank you.
Okay, let's go with one more question, please, and we're gonna wrap up. Invite everybody to stay in.
You know, I've had to know the first one I saw. Sorry.
First of all, thank you guys for coming. You guys did a fantastic presentation. Obviously, no one here in this room is the founder of a major industrial company or anything like that. But this is a great community of people that have worked skill sets. What are some ways you think that we could help you guys as your hair top of this short time in that source of
Thank you. That was a thoughtful question. I mean, I would say, and this kind of goes back to the opening remarks that were made, but and it ties into the questions that were asked. Like, realities, there's a lot of private equity firms that exist in the world. We think we have a unique value proposition. Genuinely welcome feedback on that. If anyone thinks we should refine it or it's not unique, I'm all ears. But as you guys have, folks within your network and your community that are exploring, some type of ownership transition, no matter how large or small, sometimes you get to know a business at one size and then 3 years later they call you at a different size and that's when they're ready to do something. And so just like I'm sure you guys in whatever respective field you each work in spend time on client development, I take a lot of people to dinner at steakhouses, and some of them, have a 1 year, horizon. Some of them have a 3 to 5 year horizon, but we truly view ourselves to partners with the companies that we work with. And I think that a lot of these different topics around employee ownership and strategic plan are best explored over a duration of conversations versus, I'm ready to sell, come in and explain all this to me in a 4-hour time period. So I'd say we welcome, introductions, no matter, what they may be. If unsure if it does fit, like, we're happy to still have the conversation.
Beautiful. Pay it forward net weeding, something we want to institutionalize here. So thank you for the question. Thank you for the answer. We want to thank Victoria and Pierce for their fabulous presentation, and thank you for the additional time with the questions and answers.
Of course.
Our group got a lot out of that. So
Thank you guys.
and we all have